Black Monday did not begin with bad news. It began with an opening bell at 9:30 in the morning on October the 19th, 1987. Nothing has happened yet. No war has started, no bank has failed, no president has been shot. This is the morning the machines sold everything at once, and it is about to begin. By 4 o'clock this afternoon, the Dow Jones Industrial Average will have lost almost a quarter of its value. 508 points. 22.6%. Roughly double the worst single day of 1929. The ticker tape will run 2 hours behind reality. Men who make prices for a living will stop answering their phones. And tomorrow, not today, is the day the people who ran this machinery never stopped losing sleep over. The day the whole system nearly failed to open at all. 3 questions hang over that morning. What told everyone to sell at the same minute? Why could nobody stop it once it started? And how does the largest one-day fall in the history of the American stock market arrive with no news in it? The answer to all 3 is the same answer. The instruction was written down by people, in advance, in calm rooms, years before a falling market carried it out. But this story does not start with the opening bell. It starts 11 years earlier, with a professor who could not sleep. In September 1976, a young Berkeley finance professor named Hayne Leland lay awake, worrying about money. Somewhere around 3 in the morning, by his own telling, he landed on a thought. Insurance. You can insure a house, a ship, a life. Why not a portfolio? The pension funds had just lived through 1973 and 74. 2 years that cut the stock market roughly in half. Many of them had sold at the bottom and missed the recovery, because fear has no floor. If someone could sell them a floor, a guaranteed worst case, they would never have to flee the market again. Here is how the idea worked, and it is simpler than its name. You cannot buy an insurance policy on the whole stock market, but you can copy one. Hold stocks while they rise. As they fall, sell a little, by formula, so that your losses slow down as they grow. The further the market falls, the more you sell. If it falls all the way to your floor, you have sold everything and you stop losing. On paper, it behaves exactly like an insurance policy. The word that matters is sell. The strategy protects you by selling into a falling market, automatically, no matter why the market is falling. Leland took the idea to a colleague, Mark Rubinstein, who checked the mathematics and found they held. With a salesman named John O'Brien, they founded a firm, Leland O'Brien Rubinstein. By the middle of the 1980s, it had the hottest product in institutional money. They called it portfolio insurance. It was sold in conference rooms, with charts, to the boards of pension funds. By October 1987, somewhere between $60 and $90 billion was being run on that formula, by their firm and a crowd of imitators. Call it 60, the conservative end. Keep the 60 billion in view. Every minute of Black Monday runs on it. One more piece and the machine is complete, and it is the piece that carries a crash from Chicago to New York. By 1987, the insurers mostly did not sell actual stocks. They sold futures in Chicago, contracts on the whole index at once, faster and cheaper than selling 500 stocks in New York. The 2 markets were tied together by arbitrage traders. Whenever futures got cheaper than the stocks they represented, arbitrage desks bought the futures, sold the stocks, and pocketed the gap, dragging the 2 prices back together. Chicago and New York were one market wearing 2 buildings, which meant selling pressure in the futures pit did not stay in the futures pit. The belt carried it straight onto the floor of the stock exchange. Nobody hid any of this. The formulas were published. The salesman had charts. The president of the New York Stock Exchange, John Phelan, had even used the word meltdown in public that autumn, warning what the programs might do in a genuine fall. The warning was printed, discussed, and filed. One assumption held the whole edifice up, the assumption that you could always sell, gradually, into an orderly market. In other words, the insurance worked as long as not too many people needed it on the same day. boom and bust walks one collapse at a time. Mechanism first, so subscribe if that is your kind of history. Now the week before, because Monday's avalanche was loaded on Wednesday. Wednesday, October the 14th. The government reports a worse trade deficit than expected. A congressional committee files a tax plan aimed at the takeover boom that had been holding stock prices up. The Dow falls 95 points, at the time the largest one-day point drop it had ever recorded. Thursday, another 58. Friday, 108 more, the first three-digit fall in the Dow's history, on the heaviest volume ever traded. Almost 10% gone in 1 week. Painful, but nothing the market had not survived before. Except that a tenth of the market was exactly what the insurance formulas were built to react to. Inside the machines, sell orders had been accumulating all week, and most of them had not been executed yet. The Brady Commission later did the arithmetic. Coming into Monday, the strategies were carrying billions of dollars of selling that their own rules said should already have happened. The formulas did not need news, they needed prices, and prices had fallen. The weekend supplied atmosphere anyway. The Treasury Secretary, James Baker, spent it feuding in public with Germany over interest rates, hinting that America would let the dollar fall rather than follow rates up. Foreigners holding American stocks heard that as an invitation to leave. Sunday's papers were sour, but none of it was a crash's worth of news, and that is the point that matters. Everyone who went looking for the reason afterward came back with the same empty hands. Monday opened abroad first, because Asia had had all weekend to read Friday's tape. Tokyo fell, Hong Kong fell hard, London fell harder. By the time New York's clerks were riding the subway downtown, the sell orders were stacked at the specialists' posts, waiting for the bell. 9:30, and from here, the clock is the story. The New York Stock Exchange opens by matching buyers and sellers in each stock, one human specialist per name. This morning the orders will not match. There are sellers and almost nothing else, so stock after stock simply does not open. At 10 o'clock, 95 of the 500 biggest stocks in America have yet to trade at all, including 11 of the 30 names in the Dow itself. On paper, the Dow looks merely bad. In truth, the number on the screen is being computed from Friday's prices for a third of its names. It is an average of a disaster and a mirage. Chicago opened on time. What happened in the futures pit in the next half hour is the whole crash in miniature. With New York half open, the futures were the only place a big institution could actually sell. So the insurers sold there, by formula, into a pit with no formula for catching them. Futures prices fell far below the level of the stock index itself, a discount that in theory cannot outlive the next arbitrage trade. But the belt needs both ends to work. Closing that gap meant selling stocks in New York, and New York stocks were not open, and nobody could be sure at what price anything would print. For stretches of that morning, the two halves of one market lost sight of each other completely. The formulas were not even the first through the door. One mutual fund company alone put $500 million of stock on the market at the open to pay customers who had mailed in redemption orders over the weekend. Ordinary savers, wanting out by post, arriving at the worst minute in history to want it. When the New York names did open, the waiting sell orders hit them all at once, and prices gapped down. The insurance formulas read the new lower prices and generated the next round of selling. Sell orders begat lower prices. Lower prices begat sell orders. Over the whole session, a handful of insurance-driven institutions would sell roughly $4 billion of futures and another $2 billion in stocks, more selling than anyone had ever attempted in one day. This is the $60 billion doing what it was told. The plumbing failed next. The exchange's electronic order system, built to route an ordinary day's traffic to the posts, choked on triple the record. Orders sat in queues, printers jammed, small investors' orders went in and vanished, executing hours later at prices nobody had agreed to. The tape that tells the country its prices fell steadily behind reality, until by afternoon it was describing a market 2 hours dead, which means, for much of Black Monday, nobody trading in America knew what the price of America actually was. People sold blind. When you cannot see the floor, you assume there is none. 1 o'clock. The men built to stop this are running out of money. The specialist system was the exchange's answer to panic. One firm per stock, obliged by the rulebook to buy when nobody else would, with its own capital. On an ordinary bad day, the obligation costs them an uncomfortable afternoon. This day, it asked them to stand in front of the largest wave of selling ever recorded and buy it, personally. Many did, for hours. By early afternoon, several specialist firms had spent essentially everything they had. In stock after stock, the buyer of last resort went quiet. Some stopped quoting prices altogether. There was no rule for what a market is when the man whose job is to make the price cannot afford to make one. Within days, one of those houses, A.B. Tom Paine, would be bought outright by Merrill Lynch to keep its stocks trading at all. For a little while around midday, the fall paused and the floor let itself breathe. It did not last. The formulas were still working through their backlog, and every tick lower handed them more to do. By 2 o'clock, the Dow was down around 250 points, already the worst day in its history, with 2 hours still to trade. The final 2 hours simply doubled it. The last of it went in a market with no bids, no working tape, and no bottom anyone could see. 4 o'clock, the bell, down 508 at 1738 on 604 million shares, nearly double the volume record set the previous Friday. 22.6% of the American stock market, gone between breakfast and the school run. That is not a typo, and it is still the record. The futures in Chicago had it worse. They closed down almost 29%. The distance between 22 and 29 is the truest measure of the day. It is what the fall would have looked like if every New York order had actually found a buyer. On the floor, men stood in drifts of order slips. One trader told the cameras it was the nearest thing to a war he ever expected to see from inside a building. Here is what made this crash different in kind from 1929, quite apart from its size. People watched it live. Cable television carried the fall through the afternoon, cameras on the floor, anchors doing arithmetic out loud, and for the first time, a country saw its own savings burn in real time. The brokerage houses' retail phone lines jammed by mid-morning and stayed jammed. Customers who could not get through spent the day listening to busy signals, which is its own kind of price discovery. In the evening, the president told reporters that the underlying economy remained sound, that all the business indices were up, and that the selling had no relation to the real world. The words were reasonable. They were also, almost exactly, the words of October 1929, and everyone old enough noticed. The new chairman of the Federal Reserve missed the close. Alan Greenspan, 10 weeks into the job, spent the afternoon on a plane to Dallas, where he was due to give a speech. He landed and asked the man sent to meet him how the market had finished. "Down 508, said the man, and Greenspan, for one merciful moment, took that to mean 5.08 points. A quiet Monday, before the man's face corrected him. He cancelled the speech and flew back in the morning. What he flew back into was worse than what he had left. Here is the part the anniversaries usually skip. Monday was not the dangerous day. Tuesday was. Overnight, the paperwork of Monday went looking for money. Margin calls went out by the tens of thousands to speculators large and small, pay in by morning or be sold out. And the serious version of that letter landed in Chicago. A market crash becomes a financial collapse at the clearinghouse, the machinery that settles everyone's bets overnight. Chicago's winners could not be paid until Chicago's losers paid in. On Monday night, the losers owed the Mercantile Exchange's clearinghouse about $2.5 billion, 20 times a normal day. Leo Melamed, the man who ran the Merc, spent the night on the phone hunting the money down. By dawn, there was still 400 million missing, owed through one bank, and without it, the exchange could not honestly open. The confirmation that it had cleared reached him at 17 minutes past 7, minutes before the deadline. That is how close it came. Not a metaphor, a wire transfer, with the American futures market standing behind it holding its breath. In New York, the banks had spent the night doing the prudent thing, which was the lethal thing. Securities firms had borrowed enormous sums against stock, and the stock was worth a quarter less than Friday. So the banks began pulling credit lines from Wall Street, one prudent decision at a time, each one tightening the noose on all of them. The Federal Reserve's answer went out at 18 minutes to 9 on Tuesday morning, one sentence long. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Behind the sentence, a chairman 10 weeks in the job. Behind him, officials spending the morning on the phone, persuading bankers name by name that lending to Wall Street this particular Tuesday was safe because the Fed stood behind the banks that did. And behind the phone calls, money. The Fed bought government securities in the open market that morning and kept buying, pushing cash into the banking system faster than its own habits usually allow, and interest rates, which had been climbing all autumn, were let fall. Nobody called it a rescue. It was one. It nearly was not enough. Tuesday's opening rally collapsed by noon, run over by the selling Monday's formulas had never finished, and by dealers dumping whatever they could to repay the credit lines being pulled. Stocks closed again, one by one, exactly like Monday. John Phelan, the exchange president who had spent Monday evening on calls to Washington, deciding whether he could responsibly open, now had major firms asking him to close. He kept the doors open and admitted afterward that the decision had very nearly gone the other way. Around midday, the Chicago futures pit suspended trading. For about an hour, the American financial system stood genuinely open to the question of whether it would continue. What turned it has never been fully explained, and honesty requires saying so. A small Chicago contract, the major market index, 20 blue-chip names, suddenly rallied with a violence out of all proportion to its size, dragging the arithmetic of the Dow up with it. The suspicion, argued about ever since, is that somebody bought it deliberately to turn the tape, a rescue with no signature on it. Nobody has ever proven who, and nobody ever took the credit. At the same time, corporations woke up to their own shares selling at a quarter off and began announcing buybacks, dozens of them, real bids in a market starved of any. The pit reopened, the afternoon held. The system walked out of the fire looking almost undamaged, and the people who ran the clearing machinery said afterward that Tuesday, not Monday, was the closest the modern American market has come to simply stopping. So, who did it? The country wanted a villain, and the word everyone reached for was the computers. The machines crashed the market. It is a comfortable story, because a machine can be unplugged, and it is the myth this episode exists to take apart. The computers of 1987 decided nothing. Every sale the machines sent was a policy written by people, sold by people, and approved by boards over coffee, years before the morning it executed. The formula did on October 19th exactly what its authors designed it to do: sell as prices fall. Without judgment, without pause, without asking what everyone else was doing, the machines were obedient. That is the frightening part. The Presidential Commission under Nicholas Brady spent the winter reconstructing the week trade by trade, and its finding has never really been overturned. The market was not felled by news or by value. It was felled by mechanical, price-insensitive selling from a handful of institutions, executing in hours what their models had promised could be done gradually. The securities regulator's own staff study walked the same tapes and arrived at the same shape. And when the investigators interviewed the insurers, The answers were the strangest part of the record. Nobody had panicked. The calmest people in the crash were the ones causing it, reading their formulas correctly while the floor filled with paper. What set off the first domino, the deficit, the tax bill, the dollar, is still argued in the journals. What built the avalanche is not. As for the insurance itself, it failed at the only moment it was ever needed. The floors were not delivered, because everyone reached for the exit the formula had promised them, and the exit was one door wide. The cast collected their endings. Portfolio insurance was dead as a product within months. Nobody wanted to be seen buying it. The firm outlived the strategy, and Leland and Rubinstein went back to teaching and spent years answering the same question at every conference, whether the thing they built had caused the crash. Their own answer, published the following year, was a qualified no. The selling would have come anyway under other names. The Brady Commission's numbers say the qualification is doing a lot of work. Both papers are still cited, and the argument is still open, and one payday deserves its receipt. A Memphis trader named Paul Tudor Jones had spent that autumn convinced the chart of 1987 rhymed with the chart of 1929 and positioned his fund for the fall. October paid him roughly $100 million. Every crash was somebody's payday. On Black Monday, the payday went to the people who had done their arithmetic on everyone else's insurance. What changed afterward runs straight to the present. The exchanges installed circuit breakers, automatic halts when the fall passes fixed thresholds, 7%, 13, 20 in today's rulebook. It is an admission written into the rulebook that the market could not be trusted to stop itself at machine speed. The Fed's Tuesday sentence had a longer shadow. Traders learned that when markets break, the central bank arrives with liquidity. They gave the lesson Greenspan's name, and the expectation of rescue has been priced into every boom since. And the shape of Black Monday became a genre. In 2010, an algorithmic cascade erased and restored $1 trillion of stock market value inside 40 minutes. In 2018, the machines unwound a crowded bet against volatility and took 1,000 points off the Dow in an afternoon. You have lived through several of these, whether you noticed or not. Different formulas, same design. An instruction written in a calm room, executing in a falling one, faster than any human can say stop. 1987's last surprise was that nothing followed. No depression, no recession, barely a dent in that quarter's growth. The crash with no cause turned out to have almost no consequence, and that taught the most dangerous lesson of all, that a quarter of the market can vanish in an afternoon and life simply goes on. Hong Kong, which had shut its exchange for the rest of the week, reopened down a third and carried on. Australia gave up roughly 4/10 of its market that month. London, a quarter, and every one of them carried on too, because the crash had happened everywhere and meant nothing anywhere. The world had watched the machinery nearly stop, and within a year, it was mostly a trivia question. The formulas were gone, the design survived, and it kept being rebuilt under new names, because the idea underneath it, that risk can be sold off automatically at the moment it appears, is too attractive to stay dead. One question before you go, and I genuinely want the answer in the comments. It is 1987, you sit on a pension board, and a salesman with a chart is offering you a guaranteed floor under your portfolio. Knowing only what people knew that autumn, do you sign? Because $60 billion said yes, the chart was honest, the mathematics held, and on the one morning it mattered, the machine did exactly what it promised. The instruction was the crash. That is usually how it goes on boom and bust. The mechanism is never hiding. It is printed, sold, and signed for, and it sounds perfectly ordinary right up until the morning it is not.